Welcome to our ESOP presentation. Give everyone a few, give 1 minute here, and then we'll get rolling. Just let people
Yeah, it's
kind of.
interesting how the participants have dropped. Now I guess the Zoom is bringing it back in.
Let's see how.
Wow.
Yeah, as Gia put in the chat, like we're gonna send around the slides, an article summarizing ESOPs, and you'll get a copy of the recording as well. So, because we might breeze through some of the slides here. To focus on what we want to, more interesting conversation. All right, so let's get rolling here. So I am Charlie Alvacetti. I'll be the moderator here, this ESOP panel. It's probably about 45 minutes today. We'll leave about 15 minutes at the end for questions, comments, discussions. So if you have questions, throw it in. Can we go to the next slide? All right, this is just a bit about the firm. We don't have to talk about this. Next slide. All right, I'll let Darren, why don't you introduce yourself?
Yeah, so Darren Gleeman, MBO Ventures. We've been structuring ESOPs. My firm is the private equity arm for a company called CSG Partners. We've been structuring ESOPs now since 2000. We've structured over 400 ESOPs in the last 25, 26 years. The cannabis space, I uncovered that back in 2021. I've spoken to as many people as I possibly could about it. And to date, we have structured every single cannabis ESOP, and I'm psyched to be here today to go through it with you guys.
All right, Jeremy.
Jeremy Shaw. I co-chair the corporate group with Charlie. I work in the Boston office and have had the pleasure of working with Darren and some of the CSG folks on a handful of ESOPs. It's an exciting topic. A lot of people interested. Excited to talk to you all about today.
And I'm Charlie Alvacetti at Vicente, based in DC, the happiest city in the world right now. And we'll be running through ESOPs today. So let's this is our overview. Next slide. Okay, so basics of ESOP plans. Next slide. And just so you know, like we're gonna send the slides around. Like I said, we're gonna send an article around. So this is the the real basics. This is Darren's slide, but before we get into this, just real high level, essentially what an ESOP is you sell your company to an ESOP trust that then holds the company for the benefit of your employees.
Yeah, so I'll just jump in.
Yeah, please.
Yeah, so an ESOP, it's just another way to sell your company, guys. That's it, right? You can sell your company to a private equity firm. You can sell your company to a strategic buyer, or you can sell to your employees to this thing called an ESOP. So the question is, well, why? Why sell to your employees? I mean, they have no money, right? You can get a nice offer from other people. So why sell to your employees? Well, the government wants you to sell to your employees because they want to democratize capitalism. They want all the employees to be part of it. How do they get there, right? How do we convince you as owners to sell to your employees? Well, through tax benefits, through tax subsidies, tax incentives. And when we walk through all the incentives, it makes sense that, this is a pretty good option to do it. And what I have here is just a bunch of the different incentives that you have. We can go through that now, or go ahead.
Yeah, I was gonna say just off the bat, because I've had this come up in cannabis conversations, because in the cannabis space, owners, operators are used to being sold sort of a bill of goods from all sorts of providers. So you hear something like this, and we get into the details of an ESOP, particularly the one about avoiding 280E and state and federal taxes entirely. It sounds too good to be true. The important thing to realize is, one, it is real. Two, this exists in all sorts of industries. It's not unique to cannabis. It just is particularly appealing to cannabis because of 280. And three, other cannabis companies have already done it. It's you're not reinventing the wheel. You're just taking advantage of something that's been in the tax code since 1986. This is kind of like, I would say it's sort of the ownership society concept, the idea of democratizing capitalism. So it's very real. So don't think that it sounds too good to be true, because it's real. So Next
You know,
slide,
Charlie, I always get that, by the
please.
way. Whenever I'm doing a presentation, I speak to people. At the end of the presentation, I know if I did a good job by the person saying to me, that sounds too good to be true, because there's so many of these benefits. And it does sound too good to be true. It's just that you get these subsidies. And to your point, this has been around actually since the 1970s. And the biggest problem with ESOPs is that no one really gets it. No one really understands it. So that's where when the education is really important, because again, it does sound too good to be true. Oh, and one last thing about 280E, you're not avoiding it. It just becomes completely irrelevant when you're paying no income tax, because that is one of the benefits, no income tax. So if you're paying no money, it does not matter that 280E exists.
All right, so let's next slide. We'll try and speed through this. So yeah, it's the employees in the ESOP are not direct shareholders. They're beneficiaries of the ESOP trust that holds the company on their account. The employees get sort of a proportional allocation of the stock based on their proportion of their compensation versus the total compensation of the company. There's certain caps that equalizes it a little bit. And then, you get your shares subject to vesting. So, if you don't, similar to, stock, where if you don't stay at the company long enough, you're not going to keep all these shares, if you leave.
Right, there's like two buckets, right? Right, you have the stock allocation bucket, and stock is allocated to the employees not in one day. Stock is allocated about 25 years. So if it's 25-year allocation, that would be 4% a year, okay? And it's very simple. It's just pure math, right? If I make 50 grand a year and you, Charlie, make 25 grand a year, I'm going to be allocated twice as much stock as you over that 1 year period. And the longer I stay, the more years I stay, the more stock is allocated to me. It's very fair.
So, I mean, keep in mind, of course, if you own the company, right, this is a great tool to incentivize people to stay at the company. We all know, employee tenures can be quite short at some cannabis companies. It's another added benefit. Next slide. Yeah, so just really, really basic mechanics. The company, which they call the ESOP sponsor, is, sets up this ESOP trustee, and then the trustee or the trust, which is run by the trustee, buys the stock from the existing shareholders. Now, the ESOP trust is acting like a third-party buyer in this case. So, it's negotiated like a traditional sale where you have two parties, two sets of attorneys and all that.
Yeah, so as I said before, it's just a sale. It's just another way to sell your company. And this is just the actual nitty-gritty of it. But remember, the reason why you're doing it is, it's all these, it's a huge amount of these tax benefits that you're going to be getting, that we're going to be getting into soon.
And then, of course, the big question is, well, okay, how does the trust have the money to pay me for the company stock? And the short answer is, and we were talking about this earlier, outside of the cannabis industry, it could be the case that you find a third-party lender that lends the money to the company, and that cash is used to buy out the shareholders. That hasn't really happened yet to date in cannabis. It's usually done through seller financing. So, you get issued a note in exchange for your stock, and you're paid out over, say 7 years from company cash flow. So you're not necessarily getting a big check day one, but you are going to get paid out. And then, this comes into a slide later, you also get warrants in the company, so that when the company is eventually sold to a third party, you have another chance to get paid.
Yeah, so I can go through an example of that, right? Because there is money, and it's just like, what I'd like to do is let's do a comparison, right, between private equity and an ESOP, right? And how does that work? Private equity comes in to buy your company. Let's just make the numbers big so it's easy numbers, right? Let's just say it's 20 million in EBITDA, right? 20 million net income. And the value of the company is 20 million times 500 million, make it easy math. I'm private equity. Well, here's the secret about private equity. I'm not giving you $100 million. What I'm going to do in private equity deal is, from my own fund, I'm going to give you, let's say, 20 million. Then I'm going to go out and borrow, let's say from JP Morgan, or in this case in cannabis, on AFC Gamma. So I borrow, let's say, $50 million from them, and that goes to the owners. 20 from me, 50 from them, that's 70. And the last 30 million is called an earnout. That means as long as you reach the numbers that you said you were going to reach, you get paid out. That's typical plain vanilla private equity. With an ESOP, it's very, very similar, but there's no equity. So with an ESOP, you can go out and go to AFC Gamma and borrow the same amount of money that private equity is borrowing. So you can go out and borrow the 50 million. To date, in all of the transactions that we've done, we've gotten term sheets, but they were kind of expensive. So all of our clients have decided to do all seller notes. But theoretically, you could do it. So you go out and you borrow $50 million. The company borrows the 50 million itself. You don't need the third party to lever you up. So the company borrows the 50 million, and that 50 million goes to you, the owner. Then the other 50 million is called a seller note. A seller note is an IOU from the company back to you. And that's how you get that 100 million. Now you think, oh, I might not want that seller note. No, you definitely want that seller note for something we're going to talk to you about very soon, which is these warrants. Because a warrant is like a stock option. It allows you to get a second bite of the apple. And you can get warrants for a nice chunk of the company into the future.
All right, next slide. Yeah, this is just, for the, the other question we commonly get is like, okay, I sell to, do I lose control of the company? And the short answer is that no, you don't. The ESOP will have a board of directors that will sort of govern the company as a board. But the people that run ESOPs are not in the business of running cannabis companies. So they're going to let you continue to run the day-to-day operations. Now, we talked about a sale to a third party, right? That's the kind of thing that I think the board of directors would weigh in on. But you're going to maintain your sort of day-to-day control of the company.
Yeah, the board of
Typically,
directors,
like the existing management of the company, they're going to stay on board. There may be an independent director. Sometimes you'll see some portion of the board be independent, but largely the existing management is going to continue post closing, and allow you to continue running the business. And that's kind of where both the seller note and the warrants come in. Everybody's aligned there. Like existing management, to the extent they're founders, if they have seller notes, if they have warrants, obviously they're incentivized to continue beyond their fiduciary duties. They're incentivized to keep the company going, along with the employees. I mean, now everybody is fully aligned in the success of the business.
All right, next slide. Yeah, this is what we just talked about. Next slide. All right, so that's the real basics, right? So what are the major tax benefits? I mean, Darren, you jump in. My take on that is there are three major potential tax benefits, right? One is the rollover, which is not really going to be applicable for most of the deals we're talking about. Two is tax deductibility.
the rollover, even the capital gains tax
QRP.
deferral.
Yeah, exactly. Which is not really going to be relevant for most players. But the third tax benefit is the most important one, I think, for cannabis companies, which is that if you structure it correctly, meaning if you get everything sitting under an S Corp, the ESOP trust is not a tax. I'm blanking on the term right now.
Yeah, so the way it works is, the benefits that I think it's actually that benefit of the tax deferral. That's real. I mean, people do use it. When you sell your company, and let's use that example for the $100 million company. You sell the $100 million company, or if it's $10 million company, you got to pay capital gains tax. It's very difficult to get around it. But when you sell your company to an ESOP, one of the benefits is you can defer those capital gains. And if you structure correctly, you can defer it forever. And people do use that benefit because no one really wants to pay capital gains. And that's number one. And I think it is a
Darren, the reason I was going to say is because I think you'd have to be a corporation, right, to do that. You couldn't do that with an S Corp. So it seems like the QRP is.
No, the way it works is every single company has a lot of restructuring. So all companies, the way we do it, right, is we structure the ESOP. This is to get to technicalities. You structure the ESOP inside of a C Corp. And guys, it doesn't matter because that's what the attorneys are doing. That's what we're doing. But yes, we're going to sell the company as a C Corp. And when you sell as a C Corp, you get that benefit of being able to defer your capital gains tax. That's great. Then what we do is we're going to switch you into an S Corp, right? And I know you've heard we never have cannabis firms inside of an S Corp. And that is absolutely true, except for an ESOP. Again, we structure inside the C so you can defer your capital gains tax. Then we convert you to an S Corp. And that's where the magic happens as an S Corp. The reason why the magic happens as an S Corp is a flow through entity, right? Now, if you recall from before, when we sell the company 100% to the employees, we're selling to a trust. The trust becomes the sole shareholder here, okay? The employees are beneficiaries of the trust, but there's only one shareholder. It's called an employee stock ownership trust, and that is very special trust created by the government. And the reason what makes it special is that trust pays no federal income tax and no state income tax. It's special. So what happens here is you go out and you file your tax returns, okay? Great. And your accountant fills out their normal accounting firm in the normal tax return for an S Corp. It's called 1120S, whatever. They fill out that firm. We don't evade 280E. We don't get around 280E. We're not skirting 280E, right? We don't even care about 280E. We're not taking any deductions because it's not allowed. So what happens here is there's going to be a huge profit. The next step in an S Corp is it flows through. They issue something called a K1. You probably all know about K1s. So you get a K1. There's only one shareholder, the Employee Stock Ownership Trust. They get the K1 and they're tax exempt. Hence, they pay no tax and no cash is distributed. So in that firm that we talked about before with 20 million EBITDA, that firm before this had to pay 10 to 12 million in income taxes. Now it pays zero income taxes and zero money is actually distributed. That's the huge benefit here. And now, remember I said to you, you're selling 100% of the company. Great. Okay, and we sell it for a certain multiple. It's called fair market value. And let's say again, 20 million in EBITDA, we're going to say the company's worth $100 million. So you're selling it for $100 million. So you as the owner are going to get that 100 million and you're going to be able to defer the capital gains. The company's going to run completely tax-free and you're going to get these things called warrants. Okay, the warrant will enable you, right, to have a second bite at the apple. A warrant is like a stock option, right? And so that is priced pretty well. So let's use an example of the $100 million just to get into this. You have a $100 million company, right? And let's just say we got a note. You know what? Let's just use all seller notes. We use all seller notes for $100 million. Well, the interest rate for those seller notes, and you guys all know these are high interest rates in this world. Let's just say the market rate for those interest rates for you personally should be 15%. Well, $100 million, right? 15% is $15 million a year. And in this example, you're making $20 million a year in EBITDA. That's ridiculous, right? That's egregious. So say, look, guys, instead of taking that interest rate of 15%, instead of that, you're going to take 5%, a much lower interest rate. But I just told you deserve 15. That's not fair. Well, in lieu of that interest, in lieu of that 10% that you should be getting, you're going to get warrants for you to buy back a piece of the company in the future. And you can get warrants for a nice chunk, like I said. And let's just say it comes to warrants for 20%, making it up 20% of the company. Well, this 20% of the company, and it's a $100 million company, that predetermined price to buy back 20% of your company is not going to be $20 million. It's going to be more like $5 million. And the time frame is about 15 to 17 years. And that means in English that any time in the next 15 to 17 years, whenever you're ready, you hand in those warrants, you write the check for $5 million, and you get back 45% of your company. Now, you wouldn't do that unless you have a second bite, meaning federal legalization occurs, you've blown this company up. So let's say it's $1 billion. You blew up to $1 billion. Great. Budweiser comes in and they make a bid, $1 billion. You hand in the warrants, you write the check for $5 million, you get back 45% of the company. The $1 billion comes in, the warrant holders get 450 million, and that piece you do have to pay capital gains on, but I do have an idea for that. The other $550 million, that goes to the employees. That goes to the employees, you can't screw them over. And it goes into their retirement accounts, of which they don't pay taxes until they take it out. That's why you're getting all these benefits. Because at the end of the day, this is for the employees. So the government is giving you all of this stuff. So that's what happens. And that's why when it sounds too good to be true, it is. But this is the benefit that happens to the employees. And this is why this structure is super loved by these two people, Bernie Sanders and Donald Trump. They both love the structure. And they both love the structure for different reasons. but it really is a beloved type of structure because of all the benefits that everyone gets.
And I'll
Yeah,
just add
Darren, okay,
one other thing here. In terms of, there's the deferred capital gains on the sale, the QRP. But in addition to that, if your company is already set up as a C Corp and there are certain requirements that have to be met, but if you have that stock and it's qualified small business stock, you can also use that, which doesn't defer it. It's actually a way to totally exclude capital gains on a large chunk. Actually, the thresholds there have just been raised in the new tax bill that came out. So a number of ways you can really save on taxes. Again, we've talked about on the company side, but also from the selling shareholder side.
Yeah, and that's huge. That qualified small business stock in English. You set your company up as a C Corp, and now it's 5 years later. You have to hold it for 5 years, right? This is the previous law, 5 years. Now, the first $10 million that you make as a shareholder, the first 10 million is completely capital gains tax free. So if you have 5 shareholders, it's $50 million. It's huge.
I think it's just gone up to 15 from 10.
It's 15, but that's if you start the company.
Yeah,
now.
you got to start it now.
Yeah, you start the company now. That's right.
All right, next slide. Yeah, this is just the, so sort of the details on the rollover. So you have to put the proceeds into qualified replacement property, but I think there's a lot of different kinds of QRP, right? Could be like bonds.
Yeah.
So
So
it's easy.
yeah,
It's
yeah,
a bit, it's like real estate.
yeah, exactly. Just like real estate. You sell the company for $100 million. You have 1 full year to reinvest that $100 million and here into a U.S. operating company. So that means you can buy stocks, you can buy bonds, you can also buy real estate. And here's the cool thing about that. You sell it for $100 million, you have 12 months to reinvest it. You don't have to put all 100 million in, you can lever it. So if you buy bonds, for instance, you can put 10% down of that example. So you put $10 million down, and then you buy $100 million worth of bonds. As long as you hold on to those bonds, you never pay any capital gains. When you die, your children get something called a step up in basis, and it completely goes away.
Right. Yeah. So it's a lot like a 1031. Okay. Next slide. I'm not so sure the tax deductible contributions are so relevant, just because if you structure this as an S Corp, you're not paying any taxes. So who cares about your tax deductible contributions? But if you're not an S Corp,
it matters at the very beginning, right? So when you actually structure this, and let's say we did it this year, okay, and we got it done by September 15th of 2025. All right, well, if you didn't pay your corporate taxes yet, and you should have gotten that, an extension, and you set this up for September 14th, and you didn't file your 2024 taxes, well, that means you get a deduction for 2024, and you can get a deduction, but 280E, we're not allowed to take deductions. So that doesn't work unless we use COGS, cost of goods sold. Cost of goods sold is not a deduction. So if you currently have 50% of your shareholders, let's say 50% of your employees are stuck into COGS, we can take a deduction using that. So you can take deductions. But remember, again, Charlie, we're going to do it in a C corporate first. So you get the deductions for 2024 and you get deductions for 2025. It actually becomes somewhat meaningful.
So Darren, in this situation, when would you be making the S Corp election?
So in this situation, right, the client comes in and we structure it and we're going to do the ESOP. Again, let's say September 14th. Great. They become an ESOP September 14th. You then file taxes September 15th. We have to, when they become fully tax free, we have to wait for this. But you're not allowed to do it the next day. We have to wait for the next tax period, like a calendar year or fiscal year. Most companies are a calendar year. I mean, there's some stuff we can do with that also, some really cool, clever stuff. But in this example, plain vanilla, we would wait for January 1st of 2026. And that's when we make the conversion to an S Corp. And that's when they become fully tax-free.
Okay. All right. So that's a helpful clarification, because I didn't realize you only needed to stay a C Corp for such a short period of time.
Yeah, I mean, you can stay a C Corp. A lot in the normal world, well, most people get these things done. Like we've structured to date, we've done 8 of these, right? And we did a bunch with you. We need to get a lot of these done by December 31st of 2025. Because if you miss that date, you have to wait a full year. right? Unless we convert you to a fiscal year, which is something super technical, but there are things that we could do.
Okay, cool. Next slide. Yeah, so this is just what you were explaining earlier about the S Corp structure. Next slide. Yeah, so this, yeah, it's only one at a time, right?
That's right. It's one at a time. And again, everyone out here, all of you, you're going to be restructured because if you're like a business that you have companies, you probably have what I call a chandelier structure. You have various holdcos, you have LLCs, every one of your dispensaries there's tons of different stuff. And that's where there's work that needs to be done, but you have to align you correctly. So yeah, when we structure this, and probably some of you are LLCs taxed as partnerships, that's okay. Some of you LLC taxed as Cs, some of you are just Cs. Hopefully, none of you are S Corps. But you might have, by the way, you might have some S Corps inside that chandelier structure, which is okay. But yes, we're going to do the structure inside of the C Corp, which will allow you to get that qualified small business stock, or it will allow you to get that the tax deferral. Then we bring you into the S Corp the next tax period.
Okay, next slide. Yeah, we can breeze through this. This is just
yeah, I mean, there's vesting. Just like anybody, vesting can be normally it's 5 years, right? So you get 20% a year for 5 years for an employee. That's the bucket for vesting. The other bucket is allocation. So let's say I'm there for 364 days as an employee and I quit. I get nothing. I'm there for 365 days. Then I'm vested 20%. Remember I was talking about allocation before? I'd be allocated, let's say 4% a year. So let's say I'm allocated, I should be getting, I don't know, $10,000. Okay, well, I get 20% of that, which is $2,000. That's what really comes to me because of that vesting period.
okay. That's helpful. Next slide. Yeah, I mean, this is just, there was a recent deal in Vermont, I think we saw where an ESOP deal where like the employees some of them got 7-figure payouts. So not that that's happened in cannabis yet, but I mean, people in the sort of other industries, there have been some blockbuster ESOP deals for the employees.
I bought a company. So I was an owner of a company and I bought it and we structured it as 100% owned ESOP. Okay. And my company, what we did is we had these metal bins and we still have it. And we leased these bins out to the oil and gas industry. And so it was a guy who was like 90 something years old, wanted to sell it, do an ESOP. I bought it with a group. And so we structured it as an ESOP, 100% owned by the ESOP. We had warrants, I think, for like 39% was our warrants. But the company ran completely tax-free. I was able to buy a ton of these bins, so I can lease them out to the oil and gas industry. We then went out to sell it to private equity. The bids were low. Okay, well, the bids are low. That's fair market value, right? Because that's something that to discuss later is what's the value of your company. That's fair market value. So I went in and I bid a little bit higher than what the private equity firms bid, and I bought it back. I took it private. When I took it private, all the employees got paid out. The average employee of my firm made about $800,000. And these are guys that clean out bins living in various, trailer park mobile homes in Texas. It wasn't changing for them. It was generational changing for them. And you know what? They still work for me.
Next slide. So I think we're going to speed through this. And then Darren, I just want to chat about, I mean, this is just more stuff that's, positive ESOP information. Yeah, next slide. I just kind of want to let's talk about Canada's regulatory considerations briefly, and then we'll spitball about why.
Okay.
And why and how people in the cannabis industry should be thinking about this. So the big thing, right, and this is where Jeremy has the most experience, right, is like in any cannabis deal, right, you need regulatory approval, right? That's what differentiates cannabis deal from sort of call it normal M&A, right? And the additional complicating factor here is a lot of regulators have never heard of an ESOP. So there's a lot of education, and it's not always 100% clear how you go through the background check process for an ESOP trust. And in certain states, it may not be possible because, they've got residency requirements, and what's the residency of an ESOP trust? It may not be possible, but we've done this in a number of states. And then next slide. Yeah, so it's just saying, but some states are now explicitly making this possible. So Maryland is a big one, because I'm based in Maryland, so I focus on it. But Maryland not only does it expressly allow ESOP deals, but it carves ESOP transactions out of the 5-year license transfer ban. So it's really the only way you can do a deal, other than maybe a lender company out of receivership in Maryland. And then Maine also has specific ESOP rules. Massachusetts and Minnesota are currently contemplating legislation. I'll turn over to Jeremy.
Yeah, I mean, I think there are a few things to keep in mind here. At its base, just like if you're selling to anybody, you have to get approval. So who's the owner? Who's the buyer? It's the trustee. I mean, in a trust, the trustee owns the shares for the benefit of the beneficiaries. So a few things to keep in mind there. First of all, if you have states with license caps, I mean, there are a number of folks that serve as trustees. You can hire a trustee to serve in this role. You have to make sure they're not involved with other ESOPs that might trigger these caps. Beyond that, you can consider having insiders serve as the trustee. Now, there are certain risks associated with that. And if you do that, you will want to hire advisors to assist, because there are a number of ongoing reporting requirements for the trustee. But what you may want to do to get a deal closed efficiently, start with an insider trustee, switch the trustee to a professional trustee who does this after post-closing, so that the person who's buying, the trustee, is somebody who's already in the license. Keep things as simple as, I mean, you want to keep things as simple as possible for the regulators. There is a lot of education here. They're starting to see more of it, but you'll see that. So, you'll have to deal with this in any state that's beneath the ESOP. So it can get complicated if you have a number of jurisdictions that you're working with. But largely the process and the way you want to reflect it to the regulators, this is the same as any other buyer. This is just a different type of buyer. Now, if you have jurisdictions where they're going to want to look through to the trustees, that's going to become a challenge. I mean, that's going to require some education with talking to the regulators about, look, this is how it really works. These employees are not owners of stock. They have it's a benefit plan, and really it's just the trustee to be approved. Beyond that, I mean, if we start seeing more states similar to Maryland actually having sort of increased incentives, aside from just allowing it to happen, but increased incentives for ESOP, that greatly increases the desirability of this transaction. And in a place like Maryland, it's a huge benefit to be able to get a deal done now.
Yeah, so for all those states, the only state really that won't do it is Washington, and I have a lobbying firm I'm using there. With Maryland, I was doing it in Maryland. I'm also involved with Minnesota, and also Massachusetts, to make sure that these things are even better. Yeah, pretty much you can do it in all the states as long as they're educated. They'll figure it out. And in terms of the trustee, there are these institutional outside trustees that you use at the very beginning. And those trustees are the ones that they have one goal in mind, to make sure the employees pay what's called fair market value.
Right.
And then what happens in a lot of these states, because we have MSOs, what we do is that trustee is the trustee at the very beginning. And then at the moment that it's converted and owned by the ESOP, we switch the trustee to be an internal trustee. So it could be the CEO or CFO. Exactly. And that's like at that nanosecond. So in terms of the licensing, a lot of times there's no issue with that. There's a lot of different things that can be done.
Yeah, and I think also, right, I mean, Jeremy, for when you're restructuring the organization, you also got to think about, if you're shuffling licenses around, not just at the top company, right? But if you're moving stuff around below the top company, right, to maximize the tax structure here, you got to think about licensing there.
100%, always. In every state, I mean, they're going to look at different entities in the chain, even if they're just shells to as holding companies, they're still going to ask for that. Massachusetts treats the trust itself, in addition to the trustee, as an entity, which is not really the right legal way to look at a trust, but you're gonna have to work with each regulatory body to work through that.
And that can take
both with the transaction as well as any pre-closing restructuring.
And it's going to take a second to get approval as well. So you got to realize, you got to take that into account when you're thinking about the end of the year. You don't want, you
Right,
can't,
in terms
you
of
can't submit
timing,
for
like,
approval December 1st and expect to get it done.
Oh, yeah, right now, it would be extremely difficult to get it done for the beginning of the year. That's why, remember I said, in order to do this, we have to structure you as an S Corp in the next year. Well, if you don't get it done by December 31st, you have to wait for the next year. So what we have to do is we have to change your structure from the beginning, and it's very technical, from a calendar year to a fiscal year. And there's issues of how to get that done, which we know how to do also, but yeah.
All right, next slide. I'm just trying to speed to the ending here because obviously should hire us. That's the point of this slide. Next slide. Okay, so we got this. It's good. I'm looking at the questions right now, and some of these questions are very pertinent too. Because big question we always get is like, what size, in terms of revenue, profitability, do you need to be, number of employees to contemplate a transaction like this? And then I guess backup question to that, Darren, like we were talking about beforehand, what if you're not the right size, are there any creative structures that you could pursue to benefit from this?
Yeah, so I think really to do it on your own, to do an ESOP on your own, I would say the floor is about 2.5 million in EBITDA, and that's adjusted EBITDA. That means if your company is making $1 million a year and you have a salary of 2 million, well, you know what, your EBITDA is more about in the $3 million range. Just an FYI. Yeah, so we're looking at a firm about 2.5 million in EBITDA and about 20 employees, and that pretty much is your floor. One of the things that we were discussing earlier is a way to group in, to roll in a lot of the smaller companies together, and they can do their own ESOP as in a sense, like a joint venture in a sense, where you have a holding company on top, and each one of the smaller companies, these boutique cannabis companies, become a subsidiary of the holding company, which would allow everyone to get warrants for a second bite of the apple. It allows everybody to get those seller notes, and allows everybody to partake in the warrants also. So I think that would be the structure for smaller firms.
Right. And I think that, I guess when I look at these deals, sometimes I think about it as, there's the exit portion of it, and then there's also survival, right? It's difficult to survive as a business while subject to 280E. So this might make sense for you, particularly that basket concept, right? Like let's suppose there are 5 small cannabis businesses that have a low chance of survival due to 280E and industry challenges. You could do one of these deals, right? And in my mind, it's low risk, because if you're not going to succeed anyhow, what are you really risking? And then you end up in a situation where you're outside of 280E, and your chances of survival go way, way up in that world.
Yes.
There's also competitive advantage, right? I mean, if you're competing against a company that's paying, 80% marginal tax rate, and you're paying 0%, who's going to have more cash to spend on advertising?
Yeah, exactly. And it's like, again, if you're also a little bit bigger, think about this. Once you're an ESOP and I go to acquire another company, because when you're a larger company, the way you expand is not really organically. The way you really need to expand is buying. You need to buy. So if you're buying other companies in this ESOP structure, the moment you buy a firm, the moment you buy it, all of that net income accretes to your company completely tax-free. So the cash flow that they were telling you about, that they were pitching you, now all of a sudden doubles, because now they're part of this ESOP structure. So that's it's a fairly interesting thing, and that's why a lot of people like this. Larger companies like it too.
Yeah, so we got a question about what happens if rescheduling happens. So these ESOP transactions can be unwound, right, Darren?
Oh yeah, they can totally be unwound. You're selling the company. I mean, bottom line is, when you sell the company to an ESOP, that's it. You just sold the company. Now it has a different shareholder, which is the employee stock ownership trust. But you're a regular company now. You can do whatever you want. That regular company can go public. You can buy other companies. You can sell that company. So yes, there's a lot of different things that you can do with it. If rescheduling occurs, great. I want rescheduling to occur because now it's easier to raise capital. I think a lot more money will be able to come in to the field. So it's not something where, we don't want rescheduling. Rescheduling could be great for everybody. And rescheduling, what that means is, again, that example before, 20 million in EBITDA. Now you're paying, let's say, 12 million in taxes. All right, well, once rescheduling goes away, you're not paying 12 million in taxes. You're still paying 8 million in taxes. So you're still paying a huge amount of taxes, and that still goes away. So because it goes away doesn't make an ESOP any better. I mean, ESOP is
Right.
great.
I mean, lots of companies that have never been subject to 280E do ESOPs for all these other benefits, and you're still not paying taxes. You still, I mean, we talk a lot about the benefits to the selling shareholders. The culture of the company. I mean, you're an employee-owned company. Everybody there is incentivized in what's going on. There are huge benefits to them, to the company, and to the selling shareholders that exist beyond, obviously, the huge benefit of avoiding paying 280E taxes.
Right. What makes it great, because of 280E, it gets people in here to actually listen, because everyone's being choked. In normal industries, it takes a long time to explain what this is going on, because people don't know about it. And their accounting firms don't really know about it. Most of the law firms don't know about it. So they kind of like limp into hearing about this thing called an ESOP, but they really don't know. And then we walk through the benefits, boom, 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 boom. And then I get, this sounds too good to be true.
And okay, next question. Same question. Can you provide a list of states that are supporting ESOPs at this time? Right. So, I mean, to Darren's point earlier, we think you can do this in a cannabis company in any state but Washington, and hopefully Washington is doable soon enough.
Yeah.
We've personally closed transactions in Massachusetts. I know transactions have closed in Maine, in Illinois, and am I missing any states that have actually closed deals yet?
Oregon. We're doing one right now in Ohio, Arizona, Missouri, Nevada, and Pennsylvania, and New Jersey. Now, New Jersey, there's an issue, but we have a way to get around that also. So now in Washington, there's tons of people that want to do it in Washington, but again, in Washington, there's something called true party of interest. So that's the state, and I have we hired a firm there to help us, explain how this works. And we missed the last legislative session, so hopefully we'll get that done in the last quarter or Q1 of 2026, the state of Washington.
Yeah, so you should and I guess, we were also talking about earlier, which, what I really like is this idea of like, we'll call like the basket deal, right? Where you get 5 or, half a dozen smaller companies to team up to do an ESOP deal. If not, is that, you run into the license cap issue, but you can avoid the license cap issue if the companies are in different states, right? So you could have, a handful of companies in Massachusetts, handful of companies in Maryland, right? There's license caps in both states, but as long as the overall structure is compliant in both states, it works, right? So you might have to mix and match companies from different states to not go off sides of the license cap. But then you put each of these companies in a far better position to ride out kind of the bear market.
Right, and that's what we're trying to do with a lot of these other states. You can go in; they have no limits. And some of these states, where there's definitely some issues, has not been doing that great, and the owners are being choked. Well, this is a way where joining together with a lot of these other boutique cannabis companies, remove the choke. Any thoughts on Connecticut? Yeah, I mean, Connecticut, I haven't done one in Connecticut yet. And yeah, there should be no issue with Connecticut that we can't get fixed.
Is that a social equity license in Connecticut you're talking about, Marcella? I think, yeah. So I think we talked to the regulators. I mean, I think, I would think it's possible. But yeah, we would want to be like, we'd want to have a nuanced conversation with the regulators if it's a social equity license.
Yeah, you got to explain to them that in terms of social equity, think about it. Is there anything better in the world than an ESOP for social equity? Because this way you're democratizing the entire company across, had the slide before, you're democratizing across the entire scale of the company, all the employees.
Right.
I mean, that is true social equity. I mean, it's phenomenal. So that's
in a non-ESOP company, the company gets sold. A lot of times, like, the average employee may just have to deal with layoffs, right? As opposed to getting a massive payout. Because in the average company, like the equity stakes of the average employee are pretty minimal, especially in cannabis, right? Like maybe in a tech startup, people have more equity, but in a lot of sort of like more, staid industries, right? You're not necessarily having meaningful incentive equity for employees outside of the ESOP world.
Any other questions? Everyone understands it?
Yeah, it's very easy. Well, so Darren, thank you for the clarification. There was one piece here that I understand better now. The waiting the tax period. So I guess that's even better than I thought it was coming in, because I thought you had to do one or the other.
Yeah.
But yeah,
there's so much technical, and that's why we can dilute it down to very, very simple. But yeah, if you have any questions, anybody just
reach out, and then
reach
this
out.
will be online, and yeah, we're happy to help connect you to the right people. We think this is great for the industry. We want people to make it out to the other end, as we're all dealing with these challenges. And I think this is not a ton of options to consider, but this is one I think everyone should think about hard. And if you're not the right size, maybe you team up and you do it, right? That I think is a fantastic idea, Darren. Because again, if your survival odds in the short to medium term are low, what's the, it's as you might think. I mean, obviously it's tough doing a club kind of deal because you got to get along with people. But if it gives you a chance.
That's right. Yeah, I mean, roll-ups are always hard. But in this scenario, again, if we roll everyone into the structure where you're like the subsidiary, you still have your own choices that you're going to be making. You still have your own debt. You're still doing everything pretty much on your own, but now you have a group. And by the way, there's a tremendous amount of synergies to having a very large group, which is just your buying power alone, right? Your marketing power alone, right? It makes a difference. It is better being bigger. And I'm sure you guys know that. The bigger you are, the better it is.
Yeah, you share back offices, compliance, legal, it's like a group purchasing organization. It's another sort of thing we could talk about separately. Well, anyway, I'll let everyone, get 10 minutes back here. Darren, thanks so much for your time. Thanks, Jeremy. Thanks, Gia, for your help. And feel free to reach out to us. And yeah, we're going to share all this information afterwards.
Thanks, guys.
Thanks, everyone.